Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Aux Electric Co. Limited annual report. Aux Electric Co. Limited offers a diverse range of air conditioning solutions under the brand name AUX. Their product lineup includes wall-mounted air conditioners, vertical cabinet air conditioners, domestic central air conditioning systems, and light commercial air conditioners. They also provide commercial air conditioners and commercial heat pumps for various business needs. In addition to their core products, Aux Electric Co. Limited offers project cases tailored to specific customer requirements. Their products are sold through retail stores, providing customers with a convenient shopping experience. With its extensive product portfolio and wide distribution network, Aux Electric Co. Limited has established itself as a prominent player in the air conditioning industry. Aux Electric Co. Limited market capitalization of $15 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Aux Electric Co. Limited holds a significant advantage in their industry. Aux Electric Co. Limited trades at a lower price-to-earnings ratio of 4 times and a higher price-to-book ratio of 2.24 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The company exhibits a very high leverage profile, with liabilities accounting for 84% of total assets. This elevated debt level warrants heightened caution, as it may limit the company financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be categorized into several key areas. Revenue growth drivers. The company's revenue has grown significantly due to the sale of household air conditioners, installation services, and royalty income. Government grants and income-related increases have also contributed to the growth. The expansion of online sales, particularly through new e-commerce platforms such as Douyin, has been a major driver of revenue growth. Additionally, the company's focus on energy-saving and low-carbon development, intelligent interaction, and comfort and health technologies has led to increased demand for its products. The company's diversified and premium operating approach, including exclusive strategic cooperation agreements and instant retail services, has also contributed to revenue growth. Marketing campaigns using stores as natural live streaming rooms and the integration of AI voice technology in flagship products have further boosted sales. The presence on core local lifestyle platforms and the integration with WeChat ecosystem through mini programs and social e-commerce have also been significant drivers. Revenue decline drivers. On the other hand, revenue decline has been driven by several factors. The European Union and North America markets have experienced a decline in revenue, while the South American market has seen a minimal decline. The others category has also experienced a decline in revenue. The Hudson brand has suffered significantly, with a 39% decline in revenue. Intensified market competition, rising prices of raw materials, and high inventory levels in some regions have all contributed to revenue decline. These factors highlight the need for the company to adapt its strategies to address these challenges and maintain its growth momentum. The company's net income experienced a significant decline of 23.2% due to various factors affecting its profitability. A closer look at the profit margin reveals that the gross profit margin decreased by 2.2%, from 21% to 18.8%. This drop can be attributed to an increase in selling and distribution expenses as a percentage of revenue, rising by 1% from 4.3% to 5.3%. The operating expense-to-revenue ratio remained stable, indicating that the company's operational costs did not significantly impact its profit margins. However, the intensified market competition, coupled with rising raw material prices and high inventory levels in some regions, contributed to the decline in net income and profit margins. The air conditioner industry's increased competition further exacerbated these challenges, ultimately leading to a decrease in profitability. The company's financial performance indicates a significant milestone. One of the key indicators of a company's financial health is its ability to generate positive operating cash flow. This means that the company is able to produce more cash from its core operations than it spends on various activities such as paying salaries, purchasing raw materials, and investing in new projects. The fact that the company is generating positive operating cash flow suggests that its business model is efficient and effective. It implies that the company's revenue streams are strong enough to cover its expenses, resulting in a surplus of cash that can be used for various purposes such as paying off debts, investing in growth initiatives, or returning value to shareholders. Overall, the generation of positive operating cash flow is a positive sign for the company's financial health and sustainability. It indicates that the company has a solid foundation to build on and is well positioned to achieve its long-term goals. The company's debt level and interest expenses have undergone significant changes in the recent period. In terms of debt level, there has been a notable decrease in non-current liabilities from RMB 12,082.4 million to RMB 1,840.9 million. Furthermore, interest-bearing bank borrowings under non-current liabilities have also decreased by approximately 32% from RMB 895,493 to RMB 602,846. However, despite the reduction in debt levels, the company's interest expenses have actually increased by a substantial 26.5% to RMB 57.1 million. This suggests that while the company has managed to reduce its debt burden, it is still facing higher interest costs. The company has a history of paying dividends to its shareholders. In 2024, the declared and paid dividend was approximately RMB 3,793,500,000. This demonstrates the company's commitment to returning value to its investors through regular dividend payments. In addition, the proposed final dividend for 2025 is set at RM 0.06 per share. The total amount of this distribution will be approximately RM 1,683,529,312. This indicates that the company continues to prioritize dividend payments as a way to reward its shareholders and maintain a strong relationship with them. Overall, the company's decision to pay dividends reflects its focus on creating value for its investors and stakeholders. By providing regular returns through dividend payments, the company demonstrates its commitment to long-term sustainability and financial stability. Concerns about inventory buildup and supply chain disruption are evident in the recent data. Inventory levels have increased significantly, with a notable rise in finished goods inventory by 18.3% on page 15. This is further supported by the channel inventory backlog mentioned on page 20. The accumulation of household air conditioners, plus 319,989, and central air conditioners, plus 44,468, on page 8 also suggests an overstocking issue. Furthermore, supply chain disruptions are a pressing concern. The decrease in finished goods in transit by 44.5% on page 15 indicates a potential bottleneck in the supply chain. Additionally, the continued disruptions from overseas tariff policies mentioned on page 20 pose a significant risk to the smooth operation of the supply chain. The risk of raw material price fluctuation and supply shortage highlighted on page 35 further exacerbates these concerns. The data suggests that both inventory buildup and supply chain disruption are real issues that need to be addressed. If left unmanaged, these problems could have far-reaching consequences for businesses and the economy as a whole. That concludes the financial summary for Aux Electric Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.